Hello, and thank you for joining me. My name is John Occhi. I'm a realtor with Keller Williams and the Excellence in Real Estate team, and I really do want to thank you today for joining me for this short video segment that I've prepared on a topic that I'm asked about all the time, and that has to do with property taxes in the state of California. We're talking about specifically what is Proposition 13 and how does that affect. A lot of people think they know, and the purpose of this video, let me just first throw a disclaimer in, is not to answer all of your questions, but it's to stimulate the process so that you have an idea of what Proposition 13 is, and when the time is right that you're able to ask the right questions as they apply to you. All I can suggest is that you hire a tax professional, probably whoever does your income tax can help you with this. If you do it on your own, then read the books on it and the fine print. But the bottom line is that there are some serious issues when it comes to property tax in California. So without any further ado, let me just go back into the history a little bit. In 1978, the property tax initiative known as Proposition 13 was passed. This was known at the time as a revolution in property tax, and it was a revolt of the California taxpayers. So what did this do? How did this change everything? Because today it just seems so simple, and it really is a simple formula. But a little history first. In the old days, and as it happens in many places across the country today, the individual counties or the state, depending on who the taxing authority is, but the taxing authorities always had the ability to go ahead and reassess on the current value of the home, which would mean if you bought a home 10 years ago, and let's say you paid $150,000 for that home, but today it's worth, say, $700,000, you'd be paying taxes on a $700,000 value and not the $150,000 base value. All right, well, so how does that apply to me now in California? I don't care about the old days, you say. All right, so what happens is, let's use that same example, okay? If you bought that house for $150,000 10 years ago, your property tax is assessed at 1%. That's the basis value, okay? And that's a very critical term right there, the base value or the basis value of your property. Now, the state does have the right to reassess and to increase the base value by 2% per year, and that figure will compound. So if it's 2% of 150,000, we're talking 3,000. So year two, you'd be paying taxes on 153,000. Year two, you'd be paying taxes on a compounded 2% of 153 would be another 3,060, I think, or 600. So you'd be paying taxes on that, and then each year it just increases by 2%. So your base value is always going up, and it's always going to go up 2%. I guarantee you, California is never going to give you a break and assess it at anything less. They can, and that's an issue for a whole nother video right here about property tax reduction, and especially that will be relevant once and if the market ever takes a turn like it did back in the late 80s, early 90s, where the bottom fell out and people owned property that they paid a lot more for, speculating that they were going to do something with it, and then the bottom fell out and they were upside down on their property. And yes, taxes can be recessed. Another completely different video. So stay tuned for that one if you're interested. However, the whole purpose of this video is to tell you about Prop 13. So based on that, you have a basis value. And let's go back there. All right, now, what else can trigger? What triggers a reassessment so that other than the 2% per year? There's really two things that do this, okay? Two common things. There may be others, but there are two common issues. One is when you pull a permit with the county, let's say you're going to put in a swimming pool, or you're going to do a conversion of your garage, you're going to do do a building add-on, add an extra 1,000 feet, 800 feet, do a patio enclosure, anything along those lines that require a permit, that triggers an increase in value. Now the county is going to inspect it, make sure that it's all to code, but at the same time the assessor is going to get involved and they're going to determine what the value is. Typically the value is what you paid for it, which can be kind of scary, because if you buy a swimming pool and you spend $50,000 on it, let's say you have some nice rock work or something, it will not increase the value of your property by $50,000. So if you get a $50,000 assessment, you should dispute that with the county, and it's an appeals process that can take up to a couple of years, but it's worth it, because once that's added to your base value, it stays there and you cannot change it, okay, other than just for temporary reduction in value based on a whole other scenario. So reassessment at the time of improvements is one way, and then the most common way that property is reassessed is when it's sold, when it's transferred, and it's transferred at the new rate is effective I should say the new basis rate, the base value is effective on the new purchase price. So if you bought that home 10 years ago for $150, you sold it today for $750, whereas you've only been paying taxes maybe a couple $1,000s a year, the new person is going to come in and that $750,000, if they've got a 2% tax break, although you're probably only about a 1.5%, but they're going to pay on $750,000. So they could have $10,000 or more in taxes due to the county. That's like over $1,000 a month maybe, okay? So it's a real critical factor in property tax. And that's really how Prop 13 works. And that's why a lot of folks think that taxes are going to really hurt them if they sell their home and they move into something less expensive or a smaller home. Let's take a senior, they're an empty nester, they've sold their home, they've lived there, they've raised their family, they turn around, I mean, they bought the home 30 years ago for, $30,000, $40,000, and they get $500,000 or $600,000-$700,000 for it. Now, not only do they have capital gains, but now they move into a smaller house, a third the size, and they're going to pay taxes on $300,000. That's a big bite. Okay, yes, they made money on the sale, but now they have $3,000 or a $300,000 tax burden every year. So that's the subject for the part 2 of the special report, and that's called Proposition 60. Please come back and see how that affects you if you're either disabled or a senior citizen of 55 plus. Only one member of the home has to be there. So thanks. Come on back for part 2, and we'll talk about Prop 60. This is John Occhi with the Excellence in Real Estate team, wishing you and yours a great day, making sure every day is a great day, and God bless to you both. Thanks.